Talkopolis programming is sponsored by the following. Highland Hills, a multicultural, diversified funeral home supporting the entire Davidson County community. Visit our website at www.highlandhillsfuneralhome.com or call us at 615-650-5555.
Well, hello and welcome to Pulling Purse Strings. I'm your host, Jeremy Reddick, and we have our two panelists here today, James Webb, Michael Wallen. Guys, thanks for being here.
Thanks for having us.
Today, we're going to talk about two things in life that we know are certain, and they are death and taxes. I know that doesn't sound like a very exciting topic, but it's an important one, whether you're in your 20s or 30s and just beginning to save or considering saving and putting back for retirement, or you are going to retire before the end of this year in 2014. So guys, I'll just open it up and throw it out to you. What are some things, some topics that you would like to share with our viewers as it relates to taxation today, for those that might be nearing retirement or down the road, and what kind of vehicle should I potentially be invested in based on my situation, my age group, my time horizon, those type of things?
Sure. Well, I believe that history always repeats itself. And if we really go back to looking at where we are today on taxes, they're on the discount shelf.
Sure.
You know, we've got historical low taxes. We've seen a couple of increases in taxes over the last 10 years that's taken us from a 35%, 36% marginal tax rate to 39.6. The Affordable Health Care Act has brought in for high earners some additional taxation, that surtax that's going to be on there. But we're still at very low tax rates here in the United States compared to what we've seen in the past. When we came out of the Great Depression, we were over 90% marginal tax rate on married filing jointly. 90%. So out of $1, you kept a dime.
Right.
Those were extreme taxes at that time. Now, we've got some circumstances that are developing in this country that we have to be aware of and that we need to lend an eye to determine or to at least prepare for what the future may be. We've got a shrinking workforce today. We see unemployment rates at all-time highs. We see an aging group of baby boomers moving over into retirement. Those individuals are now going on to benefits through the government, benefits that are paid through taxes, and when you have a shrinking employment base that pays into the system, the only way you can increase that to cover those benefits is to increase the tax rates. So as we look at it, we have some concerns that what are tax rates going to be in the future? And that, you bring up a great point, is where should you be invested to protect against high tax rates? And really, if you break it down, there's 4 different types of investments that you can be in. Life insurance is one of the greatest ways to invest. It's not your grandfather's life insurance policy.
Right.
It's not the death benefit plan, but it is a plan that protects and lets that money grow, and you can take tax-free loans from the policy during your retirement years. That's a great way. The second is Roth IRAs. You pay the taxes today at the discounted rate, let that money grow over your accumulation period, then you're able to take tax-free income in the future. Tax deferral through annuities and then through investment products that through either the traditional IRA or by taking and maximizing dividend distributions.
Yeah, let's talk a little bit about life insurance and Roth IRAs. Mike, you've brought up about taxation, where we're at today, where we might be in the future. If you're young to middle age, you might consider life insurance, cash value life insurance, or Roth. And the reason we say that is I like to use an analogy to explain the difference in paying the tax now and putting your money into a Roth or a life insurance policy, which is after tax, or putting your money into an IRA or 401k and not paying the tax today, but paying it down the road. And the analogy I like to use is it's kind of like, we're here in Middle Tennessee and there's a lot of farmers in the area. Basically, if you have a Roth IRA or a life insurance policy, it would be as if you went and you were going to plant corn. You bought the corn and you paid the taxation at that time that you bought the corn. You plant your crop, it grows, you harvest it, and when you sell that corn to the market, you don't pay any taxes on it. Where it's the opposite, if you have a IRA or traditional IRA, 401k, where you take the money from your paycheck or you write a check to the institution that you're investing with, and you don't pay Uncle Sam anything today. So you're not paying anything on the seed, but down the road when it grows and you're ready to harvest and you have to take money out, then you're going to pay taxes at whatever the tax rate is at that time. And as Mike pointed out, it could be much higher. So the advice that we might give has a lot to do with your particular circumstances, but we can talk a little bit in general based on age groups. So let's just say, I'm somebody, I'm under 50 years old. What advice would you give me to consider based on taxation? And I know there's a lot of variables there, guys, depending on how much income I'm earning. Will I earn more? I'm sorry, where will my taxation be potentially when I retire? But just in general terms, if I'm somebody, I'm under 50 years old right now, what's some advice you would give me? Roth, life insurance, and maybe shed a little light with for the viewers when we talk about life insurance. I'm sure many of you out there, when you hear life insurance, as Mike pointed out, it's simply a death benefit is what I think. I get term insurance. If something happens to me, my wife is going to get a check that's going to, hopefully, I have enough coverage that's going to cover all of her needs so her lifestyle doesn't change. But I can tell you, life insurance, there's a lot of life insurance out there that's very different than that. Let's start with life insurance and we can talk about Roth. Just general terms, guys, for the audience to be able to understand how they can harness the power of a life insurance policy.
Great. Well, if you'd like me to share a little bit about and you brought up a good point, the difference in the types of life insurance. Mm-hmm. You have term insurance, where you're renting coverage for a specific period of time. Then you move into whole life. Whole life is there. Could be dividend.
Not to cut you off, but maybe I'm sitting out there and I've never even had term insurance. Don't fully know what it means. Yeah. Explain it. What does term insurance mean? Break it down just a little bit for the viewers.
Sure. Well, term insurance is, as you're going in, you determine that you need a specific amount of coverage for a certain period of time. And there is no cash value built up inside of the policy. You're paying the least amount of premium on the cost of insurance, but it protects your need for that specific period of time. And it could be 10 years, it could be 20 years, it could be 30 years. Okay, and at the end of that time period, that plan is exhausted. You have no residual return from it, unless, of course, you pass away during that time period. Again, it's protection just for a specific period of time for a specific amount of coverage.
And that type of insurance, Mike, that is really used for the death benefit. That's really what it's used for. That's its purpose. There are some policies out there that have a return of premium rider. If you're looking at term insurance, you might check that out. It's much higher premiums, but if you don't pass away, say you had a 10-year term policy and 10 years down the road, you would get the premiums you deposited over that 10 years, you would get that premium back. But term insurance is just what, Mike, you're sharing with the group. That's what it is. Now talk a little bit about permanent insurance and the types of policies.
In the permanent side of the business, you have whole life, you have universal life, and then you have a new design, which is indexed universal life, which really gives the consumer the opportunity to grow inside of their plan based upon a following of an indice, whether it be the S&P 500, it could be the Dow, but it's following an investment strategy that allows you to accumulate more inside of the plan. For those individuals that are looking for tax-free income in the future, they will either use a whole life, they're going to use permanent coverage, it'll be whole life, indexed universal life, or they'll use a universal life product.
And let's share, so we're talking a little bit about permanent insurance. And by the way, folks, the month of September is Life Insurance Awareness Month. Most of America is underinsured. You pay your premiums for your rental insurance on your house that you're renting or apartment, or your homeowner's insurance on your automobile insurance, and you don't bat an eye about it, right? It's just what you've always been taught and trained to do. That's what you have to do. Heaven forbid you have an accident or there's some type of claim that needs to be placed. Seriously think about, what if something happened to you and you were unable or were no longer here, unable to provide that income to your family? seriously consider the topic we're talking about and talk to a local agent, because there is a huge need out there for you and your family, especially if you're the breadwinner. And if you're not the breadwinner, a lot of people forget there's that spouse that may be giving care at home. If all of a sudden something happened to him or her and now you're having to pay for somebody to give that care, you need to factor that in. But changing gears and going back to the permanent insurance, Mike and James, let's just talk a little bit. If I'm somebody and I'm sitting down with you and I'm considering permanent insurance for not just the death benefit, heaven forbid something happen, but I'm looking at it for tax-free income down the road. Explain a little bit, how can I get tax-free income down the road from investing in a life insurance policy, a permanent life insurance policy?
Well, the IRS tax code allows life insurance to be the only investment vehicle available that provides tax-free benefits, no probate, and have the ability that you can borrow from your own cash savings inside of the plan at a no tax rate basis. So that is the best plan out there. It's a plan that you put your money into. If you die prematurely, you have the death benefit that goes to your family. If you're fortunate to live long enough into your retirement years, you can borrow against that plan, a plan that continues to grow based upon that indice. So that cash value, as you're taking money out, depleting down the value, it still has the ability to grow like other investment vehicles, but you're borrowing the money out. You don't have to repay the loans. And so that gives you a tax-free loan during your retirement years to help you benefit or supplement your retirement income needs.
So to break down what Mike shared with us today, you can, in a life insurance policy, take money that you have in the bank, your checking account savings, or that out of a paycheck you get every month, and you can invest, you pay taxes on that money, you put it into a life insurance policy. That money hopefully grows, and as Mike talked about, there's whole life that's permanent, there's the index UL, which is growing rapidly, and the reason that it is the way that policy is structured. You will not lose any money due to market performance, and that's what makes it very appealing for many investors. But basically, you put your money in there, it grows over a period of time, and at a future date, you would take money, borrow it from that policy, and you do not have to pay it back during your lifetime. Should something happen to you, whatever cash values left minus what you received would go to your heirs. So life insurance is a product out there, and again, September's Life Insurance Awareness Month, that you should probably take another look at and find out if it might be a fit for a portion of your portfolio or your investments.
You know, there's another insurance product that's available too that I think is often overlooked for the fact that we can achieve a lot of the things we're trying to do, which is investing wisely in a tax-efficient manner. And you brought up a point earlier that we have life insurance, or we have insurance on our house, we have insurance on our cars, we have insurance on our lives. But a question I ask my clients is, do you have insurance on your money? And the answer is usually no, because they're not familiar with that term. And if you look at annuities, annuities is a great way to invest in a tax-efficient manner because your money grows tax-deferred. And essentially what you're doing is you're shifting the investment risk from yourself over into the insurance company. And then we can add what's called lifetime benefit riders, where you get a guaranteed growth into an income account and create for yourself a personal pension plan.
And that's a great point, because unfortunately most of America working force today, such as ourselves here, we don't have a pension plan. So there are vehicles out there that you can get a guaranteed income stream from the insurance carrier that works as if it's a personal pension plan. So we started the segment talking about two things that are certain in life, which are death and taxes. And we talked about life insurance, which can help, heaven forbid, if something happened to you and there was a death, and then also the taxation to potentially be able to, if taxes are going to be higher down the road, if you had a life insurance policy and you're taking money out of it, it's not affecting your Social Security, you're not paying taxes on those dollars. So we appreciate you all joining us today on Pulling Purse Strings, and we'll see you on the next episode. Thanks so much for joining us.